The Fed has just held US interest rates, but it's lowered its growth forecast, pointing to new uncertainty. The US dollar slides on the move, gold jumps to a new record high. The Bank of Japan also holds but is expected to keep hiking. Australian jobs data today is forecast to show more growth. Yet New Zealand GDP data is likely to show growth again after a recession. That's coming up in our 5 Things in 5 Minutes on Thursday, March the 20th. And then, in today's bonus deep dive interview, ANZ Pacific economist Kishti looks at Fiji's growth outlook and what is needed to drive growth after the pandemic.
To my mind, trade is the answer. Can Fiji offer something that is more than just tourism, something other than trading services? Of course it can.
But first, in 5 and 5 with ANZ, the Federal Open Markets Committee has just announced it has held US interest rates, but its dot plot of forecasts shows it has lowered its economic growth outlook. It's also forecast 2 more Fed rate cuts later this year. Financial markets immediately reacted to the prospect of more rate cuts. The US dollar index fell. The Aussie and the Kiwi dollar bounced. The S&P 500 rose a bit on the prospect for that lower Fed funds rate. Shortly after 5 a.m. Sydney-Melbourne time, the US dollar index was 103.27. That's down from 103.55 just before the Fed decision. The Aussie dollar bounced from 63.23 to 63.40 US cents, while the Kiwi bounced after that Fed decision to 57.93 US cents from 57.75. The S&P 500 was up 0.7% at 5:20 a.m. Sydney-Melbourne time after it bounced 20 points on the Fed decision. Gold jumped to a new record high of $3,047 an ounce. That's up 0.2%. Number 2. Meanwhile, the Bank of Japan also held rates as expected at 0.5%. ANZ senior international economist Tom Kenny says policymakers signalled unease about US tariff policies and trade volatility, but they're likely to keep normalising rates.
We are expecting the Bank of Japan to proceed with another hike in the April-May meeting. And this is largely on the basis that the Bank of Japan will have the full set of trade union wage negotiations then. These are expected to show wage increases in the range of 5 to 6%. And this should solidify the view that the strengthening nexus between wage growth and inflation should lead to sustainable 2% inflation over the longer term.
Number 3. Australia's unemployment rate is expected by ANZ Research to have fallen to 4% in February, just down a bit, with employment growth of 35,000. ANZ Head of Australian Economics Adam Boyton says this would be the 12th month in a row of unemployment sitting within a tight 3.9 to 4.2% range.
We've had a pretty robust tone to jobs growth in Australia through much of the past year. We've gone from a year or so ago, an environment where job ads were trending down to where job ads are now in our ANZ Indeed monthly job ad series trending sideways. And then there has been a tendency in the past couple of years for February or March to come in on the strong side.
Number 4. New Zealand's economic recovery is expected to have got underway in the fourth quarter of 2024 after a mid-year recession. ANZ economist Henry Russell expects GDP data today to show 0.4% growth in the December quarter. That's close to the Reserve Bank's 0.3% forecast.
In fact, we are seeing some mild upside risk to that figure following yesterday's balance of payments data, but the details on the day are going to be key, and that a lot of the growth is likely to come through technical factors relating to how Stats New Zealand seasonally adjusts the data, and we suspect that those are going to flatter the headline growth rate, and under the hood, underlying economic momentum is likely to remain very soggy.
Number 5. Bank Indonesia held its benchmark rate at 5.75% yesterday amid financial market turmoil on the back of worries about the government's fiscal position. Indonesia's stock market plunged 7% earlier this week and the currency also dropped. ANZ Head of Asia Research Koon Goh says a rate cut would only have added to the disruption.
BI kept their growth, inflation, and current account deficit forecasts unchanged from their February meeting and is still on the lookout for opportunity to cut again at some stage. However, investor concerns over the growth and fiscal picture is likely to keep the rupiah under pressure in the near term, especially as global risk appetite is likely to remain volatile, especially as we head close to the 2nd April announcement of further US tariff action.
Couldn't go there. Now, in today's bonus deep dive interview, ANZ Pacific economist Kishti talks to my colleague Alex Tarrant about Fiji's economy and how it looks to resume stronger growth in 2027 after 2 years of plateauing.
I think you could describe Fiji's economy as something that is at a point of inflection. It's had this remarkable recovery from the pandemic-induced recessions and in a very short space of time. So an inflection point essentially means that do we see Fiji's economy continue to grow at a fast pace that we have seen recently, or does it stabilize, or does it go backwards? I think we can confidently rule out an economic contraction as the underlying drivers of the economy remain sound. So right now, we believe activity has stabilized somewhat and economic growth has normalized in the high 2 to 3% range. And that's what we saw prior to the pandemic on average. And that's what we see as the most likely outcome for Fiji's GDP growth over 2025 and 2026.
So if you're saying growth will plateau in 25 and 26 a little bit, what exactly does that mean and what are the key drivers of the plateauing?
Private investment is coming through quite strongly. It has been bumping around at the bottom of the cycle for quite some time, with businesses waiting for certainty in demand before they pull the trigger on investment. We have seen building approvals for things like shopping malls, warehouses, and offices shoot up in the second half of 2024. And as these projects go to commencement, they will join the hotels and resorts construction that is just started. And overall construction activity will ramp up, adding new jobs to the economy, which in turn will support private consumption expenditure. So we are looking at private investment as picking up the baton, if you like, from international tourism and drive the economy forward over the next 2 years.
So as overall growth, though, looking at overall growth, as that sort of slows at this inflection point, does Fiji need to be concerned at all about the aspirations it's got for development? So I assume it would like to grow at a faster pace and create more jobs for the country. So should it be concerned at all?
Well, that's always the conundrum for small island economies, isn't it? The constant challenge to keep the economy growing at a good clip to absorb people looking for jobs into the workforce, and more importantly, to lift government revenue so it is in a better position to deliver core government services and build infrastructure. So how does it do it? Well, to my mind, trade is the answer. Can Fiji offer something that is more than just tourism, something other than trade in services? Of course it can. There are opportunities in offshore business processing, medical export, retirement living, downstream processing of commodities like fish and timber. Fiji can become a regional manufacturing and distribution hub, and it can continue to grow exponentially its exports of organic ginger, turmeric, and kava. So these are some of the options. However, to unlock the potential that Fiji has in trade of goods, foreign direct investment will hold the key. And Fiji government is working hard to bring global investors to town, and hopefully some deals can be struck down the track so Fiji can realize the potential it has in exports of goods and complement the strong position it holds in services trade.
Kishti there, speaking to my colleague Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, March the 20th. Catch you tomorrow with what today's Australian jobs market report and the New Zealand growth data could mean for interest rates in the two economies. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.